If you have $20,000 in cash in your bank account, in your home, in a safe or even a safety deposit box right now in April 2026, could that money get your account flagged by your bank? Could it trigger a government report? Could it interrupt your CPP, your OAS, or your GIS? I know those questions are alarming, and I know some of you might be thinking, oh, I've done nothing wrong. Why should I worry? Here's the honest answer, because the rules in Canada just changed in a very significant way. On March 26, 2026, just 1 month ago, the federal government signed into law Bill C-12, which completely rewrote Canada's anti-money laundering rules. And the impact on everyday Canadians, especially seniors living on fixed incomes, is something you simply cannot afford to ignore. Stay with me for the next few minutes, because by the end of this video, you will know the exact 2026 rules, the precise April 2026 benefit amounts for CPP, OAS, and GIS, and the clear steps to protect yourself and every dollar you have worked so hard to save. Let's get into it. It starts with a law that received almost no coverage from mainstream media, despite touching the lives of every Canadian who holds a bank account. Just 1 month ago, as of this recording, the Strengthening Canada's Immigration System and Borders Act, commonly known as Bill C-12, received royal assent. Most of the headlines focused on immigration reform, but buried deep inside this wide-ranging legislation is a comprehensive rewrite of Canada's Proceeds of Crime, Money Laundering, and Terrorist Financing Act, the law that determines how banks must monitor and report your cash transactions. And what changed inside that law is something every Canadian senior needs to understand before they walk into a bank branch with a large amount of cash. Because the environment surrounding money in Canada in 2026 is fundamentally different from anything we have seen before, and the consequences of being unprepared are real, serious, and entirely avoidable if you know what to do. Here is what changed in plain language and why it matters to you directly. First, the financial penalties for banks that fail to properly report suspicious transactions have been dramatically raised. Under the previous rules, the largest fine FINTRAC had ever imposed on a Canadian bank was under $10 million. Under the new rules, a single prescribed violation can result in a penalty of up to $4 million for an individual and up to $20 million for a business. When multiple violations are stacked together, the cap rises to $20 million or 3% of a bank's total global revenue, whichever is greater. For the largest Canadian banks, that could translate into penalties reaching into the billions of dollars. What does this mean for you personally? It means your bank is under greater pressure than ever before to flag anything that appears unusual. Their compliance software has been upgraded, their staff have been retrained, and the cost of failing to report something suspicious has never been higher. So they will always choose caution over convenience, and that choice affects you every single time you walk through the doors of your branch with a significant amount of cash in your hands. Second, all financial institutions in Canada, including banks, credit unions, insurance companies, and mortgage brokers, must now formally register with FINTRAC and renew that registration on a regular basis. FINTRAC's supervisory reach has never been wider than it is right now in April 2026. Third, the new law is laying the foundation for a ban on any business or charity accepting cash payments of $10,000 or more. Banks are also moving to prohibit third-party cash deposits, meaning someone depositing cash into your account on your behalf. The specific regulations are still being finalized, but the direction is absolutely clear, and every Canadian senior needs to understand which way that wind is blowing before it becomes a problem in their own financial life. Now, here is the most important question at the center of everything we are discussing today. Does this mean the government is targeting seniors? Absolutely not. But it does mean the system that monitors cash is more sensitive, more automated, and more aggressive than it has ever been in Canadian history. And as a Canadian senior receiving CPP, OAS, or GIS, you need to understand how to move through this system safely, confidently, and without unnecessary disruption to your daily life and your monthly income. The rules exist to protect the integrity of Canada's financial system from criminal activity, from money laundering, from terrorist financing, from organized fraud. They are not designed to make your life difficult. But if you do not understand them, they absolutely can make your life difficult. And that is exactly what we are going to prevent together right now. This next rule has not changed, but the consequences for banks that overlook it certainly have, so let's make sure you understand it fully before we go any further. Under Canadian law, any single cash transaction of $10,000 or more must be automatically reported by your bank to FinTrack within 15 calendar days. This is called a large cash transaction report. Your bank does not need to warn you. They do not need your permission. The report is filed automatically every single time, without exception, without discretion, and without any possibility of skipping it based on how well the teller knows you or how long you have been a customer at that branch. It happens every time. Full stop. Now here's the part that many Canadians, including many seniors, get completely wrong. They believe they can avoid this by keeping their transactions just below $10,000, perhaps withdrawing $9,500 or depositing $9,800 or making two separate deposits on the same day to stay just under the limit. They assume no report gets filed. That assumption is extremely dangerous, and it could expose you to serious legal consequences even if every dollar you are dealing with is completely legitimate and came directly from your pension. Deliberately breaking up transactions to avoid the $10,000 reporting threshold is called structuring, and it is a criminal offense under Canadian law. Even if every single dollar involved is completely legitimate, even if it came from your CPP pension, even if you earned it over 40 years of honest work and careful saving, structuring is illegal. Full stop, no exceptions, no gray areas. The law does not ask why you broke up the transactions. It only asks whether you did it deliberately to avoid the threshold. And if the answer is yes, the consequences can be severe. There is also the 24-hour aggregation rule you must understand, because it catches many Canadians completely off guard when they think they are doing everything right. Under FinTrack rules, if you make two or more separate cash transactions that together total $10,000 or more within a single 24-hour period, the bank treats all of those transactions as one large transaction and files a report automatically. So two deposits of $5,500 within the same day equal $11,000 in FinTrack's system and trigger a report without question, without warning, and without any possibility of taking it back once it has been filed. And under the new 2026 rules introduced through Bill C-12, banks are also moving toward prohibiting third-party cash deposits entirely. If your daughter, your son, your neighbor, or your caregiver attempts to deposit cash into your account at a bank branch on your behalf, the bank may refuse outright. This is a significant shift that many Canadian families are completely unaware of, and it is already creating real confusion and real frustration at bank branches across the country. Let's address the core question of today's video directly and honestly, because this is what you came here to find out. What actually happens if you have $20,000 in cash right now in April 2026? The first thing to understand is this: holding cash is not illegal in Canada. There is no law preventing you from having $20,000, $50,000, or $100,000 in physical Canadian currency, whether it is in your home, in a safe, or in a safety deposit box. You are permitted to save. You are permitted to hold cash. That has not changed and is not under threat. But the moment you attempt to deposit that cash into a bank in 2026, you will face scrutiny. And given the new enforcement environment under Bill C-12, that scrutiny is now backed by penalties so severe that no bank will take any chances with an unexplained large cash deposit, regardless of how long you have been their customer, regardless of how modest and predictable your financial history has always been. Here is how it typically plays out for a Canadian senior. Let's say you receive an average CPP of $925.35 a month, along with OAS of $743.05. That is just over $1,668 monthly from the federal government, a steady and predictable income that has been arriving by direct deposit into your account like clockwork for years. Now, let's say you have been setting aside a couple of $100s in cash each month from your pension for the past 2 years, keeping it safe at home because you were saving for something special, maybe a grandchild's graduation, maybe a home repair you knew was coming, maybe simply because it gave you peace of mind to have something set aside. You have accumulated roughly $20,000. You decide it is time to deposit it. You walk into your bank branch with $20,000 in cash. The teller reviews your account history, a steady $1,668 monthly direct deposit from Service Canada, modest and regular expenses, no significant prior cash activity, and suddenly there is a $20,000 cash deposit sitting on the counter in front of them. This is a major anomaly in your financial profile, and under the new 2026 rules, the teller has no choice but to escalate it immediately. A report to FinTrack is filed, Your account may be placed on hold for review. None of this means you are being accused of anything. None of this means you have done anything wrong. But the disruption to your daily life, the potential delay in accessing your funds, the paperwork, the phone calls, the worry, all of it is completely real. And for a senior depending on those funds to pay rent, purchase medication, or cover living expenses, it is genuinely serious and genuinely stressful in ways that no one should have to experience unnecessarily. Let me share with you 3 real stories from Canadian seniors that illustrate exactly what we are talking about, because numbers and rules only tell part of the story. The human experience behind them is what will help you truly understand why the steps we are going to discuss matter so much. Frances is 71 years old. She retired 5 years ago from her position as a dental office administrator in London, Ontario. She receives CPP of $1,040 a month and full OAS of $743 as of April 2026. She does not qualify for GIS because her small workplace pension pushes her income just above the eligibility threshold. Over the past 3 years, Frances had been setting aside $300 to $400 in cash each month from her CPP and OAS, money she was saving to give each of her 3 grandchildren as a graduation gift. By March 2026, she had accumulated $14,000 stored in a tin box in her closet. When her eldest granddaughter graduated in April, Frances decided to deposit the $14,000 and write a check. She went to her bank on a Tuesday morning, presented the cash to the teller, and requested a deposit. The teller immediately called the branch manager. Frances's account was flagged for review under FinTrace's large cash transaction reporting requirements. Her account was placed on a temporary hold while compliance officers reviewed the transaction. She received a letter asking her to explain the source of the funds within 7 business days. Frances had no paper trail, no receipts, no withdrawal records organized by date, no written log of how she had saved that money over 3 years. She spent 4 stressful days gathering statements, calling her bank, and explaining her situation to a compliance officer over the phone. After 9 business days, nearly 2 full weeks, the hold was lifted and the deposit cleared. Frances had done absolutely nothing wrong. But she told her daughter afterward, "If someone had simply told me to keep a basic notebook, I would have saved myself weeks of stress. Nobody warned me." That is exactly why you are watching this video today. Thomas is 77 years old as of April 2026. He receives full OAS at the enhanced rate of $817.36 per month, which is the rate for seniors 75 and older, plus CPP of approximately $860, plus GIS of $890 per month based on his modest income from small RRIF withdrawals. His total monthly federal income is approximately $2,567. Thomas's wife passed away in January 2026, and after the grief of losing his partner of 48 years, he also had to navigate the practical and financial realities of settling her estate. He inherited her savings, $28,000, held in a credit union account she had maintained separately and never merged.